Hi everyone and welcome back to a brand new episode. My name is Marcus and I'll be your host. In today's episode we're going to take a look at AMD. If you're new to this channel, welcome. What we do here is that we study and analyze stocks. We go through the fundamentals and the technical analysis of a stock, but we also talk about finance and investing. And if you've been here before, thank you so much for coming back. I truly hope you guys will enjoy this episode, and please give me a thumbs up, comment, subscribe, and let me know what you think, but also what stocks you want me to take a look at. Thank you so much. Now let's get started. As I mentioned, today we're going to take a look at AMD, and if we go down to the screen, you can tell that they are in the manufacturing sector and they are traded on NASDAQ. Their market capitalization is at $132 billion and their revenue is at $13 billion. Their PE ratio is at 38. Now guys, you know I like to take a look at companies with a PE ratio of 20 or below. So having a 38 on PE ratio, that is just too high. But that also means that the market expectation of the company is high. And the risk is, if they don't meet those expectations, we will see the stock price fall. So PE ratio of 38 is too high, so that is a no for me. Their profit margin is at 25%. I like it a lot. I like to take a look at companies with a profit margin of 15% or higher. So having a profit margin of 25%, I like that. So that is a major goal for me. Now, their price to sales ratio is at 9.9, and that is too high in my eyes. I like to take a look at companies with a price to sales ratio of maximum 2. So having a 9, that is too high. So that is a no for me. And their price to book value is at 18. Normally, I like to take a look at companies with a price to book value of maximum 3. So having 18 is just way too high. So that is a no. And if we summarize it, we can tell that the PE ratio is too high, the price to sales ratio is too high, the price to book value is too high. That tells me that the company is overvalued. If we go on and look at the dividend, they don't pay out any dividends, which is a shame. I like those dividend income. And their return on equity is at 66%. I like it. Basically, what return on equity tells us is that a company's ability to create return on the invested equity. And as for investor, especially when a company doesn't pay out any dividends, it's critical to take a look at the return on equity and see if the company is able to create a return on the capital that you invest in the company. So 66%, I like that. So that is a major goal. I like that. Return on assets, 18%, looking good. I like that. So that is a major goal. And the stock is currently traded at $106 per share. And if we take a look at the 50-day moving average, we are trading above, not much, but we are trading above, and also trading above the 200-day moving average. So this is a clear signal that we might see price go even higher. And if we take a look here on the chart, we can see just short that we have been moving up higher levels, but overall we can tell that we have been consolidating over a quite period of time, and now we are seeing higher moves, and we broke that resistance level and now trading higher. So let's take a look at this the technical analysis further down. But now let's move over to the income statement. And what we can tell by the look at income statement is that the total revenue went from $4.3 billion in 2016 up to $9.7 billion in 2020, and it has been growing steadily ever since, and I like that. Gross profit went from $1 billion up to $4.3 billion and also has been growing steadily ever since. I like that. And the net income their net income, they've been having some loss, but over the 2 years we had loss, and then they improved went with a plus of $337 million, and it has been growing steadily ever since. I like it. I'm liking what I'm seeing right now. Now let's move over to the balance sheet. And what we can tell here, and what we are most interested in, is that the current assets versus the current liabilities, and we can tell that there is a huge difference between the current assets and the current liabilities. I like that. So basically what it tells you is that if the company converts the current assets to cash, they are able to pay off their current liabilities, and that is a plus. But also they are able to pay off their total liabilities. Basically they can pay off all the debt. Imagine being able to pay off your student loan, your house loan, your car payment, everything. So this is a major goal, and still having a difference of $3 billion. So that is a major plus. I like this one. Now let's move over to cash flow. And what we are interested here is that the operating cash flow, and we can see how it went from $81 million up to $1.1 billion, and has been growing steadily ever since. But what's most important here is that the difference between the operating cash flow and the capital expenditure, that's what we want to take a look at, and we can tell that there is a huge difference between operating cash flow and the capital expenditure. So that is a major plus, and we can tell here that the numbers have been improving. 1 year we didn't perform that as well, but overall we are doing better and better. So I like this one. Now let's move over to the key figures. And what we can tell here is that the earnings per share went from minus $0.5 per share up to $2 per share, and has been improving ever since. 1 year we fell off, but overall we are doing great. We are in the right direction. Revenue per share went from $4.5 per share up to $8 per share, and also has been growing steadily. 1 year we fell off, as we saw above, but overall we are in the right direction. I like this one. Equity per share went from $0.5 per share up to $4.8 per share, and also has been improving ever since. I like this one. Dividend per share, that doesn't pay out any dividend, which is a bummer. I like the dividend income. So that is a minus, but let's skip that one. Gross margin went from 23% up to 44.8%, and has been improving ever since. I like this. Even though what this tells us is that the company is becoming more and more efficient, which is great. I like that. But we also need to be cautious, because we saw here that we have a gross margin of 44.8%. That basically tells us, imagine you sell a product for $1, you get to keep 44 or 45% of that dollar. That means more than 50% it goes to the cost of goods sold, and that tells me that they still, even though 44% is it's not that high, but I would love to see them become more and more efficient and reduce the cost of goods sold. So I want to see that they continue to improve and become more and more efficient. Operating margin went from minus 10.6% up to 13%, and has been improving ever since. I like that. Profit margin went from minus 11% up to 25.7%, and also has been improving ever since. I like it. Return on equity went from minus 104 up to 42%, and has been improving. 1 year we fell off, but overall we're looking good. Basically, return on equity, as I mentioned, it tells us about the company's ability to create a return on the invested equity. And that's for an investor, especially when a company doesn't pay out any dividends, you need to take a look at return on equity and see if the company is able to create a return on the capital you invest in them. So 42%, I like that. So that is a plus. Return on asset went from minus 15% up to 27.7%, and also has been growing. We fell off 1 year as we saw before on other areas, but overall we're doing great, so I like that. Solidity went from 14.3% up to 65% and has been growing ever since. I like it. Basically, what it tells us, solidity is how much of the total asset is financed by the equity, and it also tells us about the company's financial strength for the short term. And as we can see here, it has been improving, which is great. I like it. Balance sheet liquidity went from 1.6 up to 8.6 and has been growing ever since. I like it. Basically, balance sheet liquidity, similar to the solidity, it looks at the company's financial strength for the long term, and we can tell it has been improving every year. I like that. So that is a major goal. Debt ratio went from 5.9 down to 0.5, and it has been falling ever since. That is a plus. Basically, it tells us here at 2020 that it had a debt equity of 0.5, meaning that they had 0.5 times more debt than equity in the company. So and they have been reducing their debt. I like this a lot. So now we have gone through the income statement, the balance sheet, the cash flow, the key figures, and now over to the most important part of our software, which is the pillars. And basically what the pillar does is that it gives you an easy to read, easy to digest overview of the company's performance. In just one glance, you get everything we have gone through. For example, if we summarize, we can tell here that the PE ratio is above 20, which is a minus. They don't pay out any dividends, which is a minus. And the number of outstanding shares have increased, which is a minus. Basically, what it tells you as investors, if you see a company increase their outstanding shares, it means that your share of the company is decreasing. A lot of companies take on capital, bring in capital by increasing shares. A lot of investors will be looking at a company and look and see that the company is not taking on the debt is not increasing as that much, but the total the outstanding shares is increasing rapidly. So a lot of people missed it. Instead of taking on loans, and the balance sheet looks great, but the total outstanding share is increasing rapidly. So you be cautious of it. So when you see a company reducing their total outstanding share, that means that your share of the company is growing because there's fewer and fewer outstanding shares out there. So they have been increasing it, so that is a minus. Revenue increased over the past 5 years, that is a plus. Profit margin above 15%, that is a plus. Profit increased over the past 5 years, that is a plus. Current assets is greater than current liabilities, that is a plus. And solidity increased over the past 5 years, that is a plus. Balance sheet liquidity increased over the past 5 years, that is a plus. And debt equity ratio decreased over the past 5 years, that is a plus. And total liabilities have been growing over the past 5 years, that is a minus. As you can tell, guys, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. Now, if you want to dig through the numbers, you can dig through the numbers. But if you want to have a fast, easy to read overview of the company's performance, the pillars is the right tool for you. And you can have this software along with everything we've gone through for only $25 per month, and it's yours to have. You also get access to our page, our analysis page, where we publish articles and videos of more analysis. And also you get access to our chat, where you'll be able to chat with me alongside with other members. So jump on, become a member today. Now let's move over to the technical analysis of the stock. So here we have the stock. Let's take a look. Let me just draw the lines here. We have a support line over here. And let me just draw the resistance line. And we have something like that. but I can also see right away. Let me change that color to red. Let me see here, but also I can see here that we can lay a line like this, something like that. And let's change color to, let's say, let's pick that one. Yeah, so what we can tell here is that the channel that we are trading within is expanding. As you can tell, it is expanding, which tells us that we will see greater movement as we move, as times progress. But we also can tell here that you saw earlier that the stock price is traded above the 50 and the 200-day moving average, which tells us, which is an indicator that we might see price move even higher. So basically what it tells us that we might see something like this, that the price will try to break this resistance level, but we also might see that price fall down and hit this support level. As we can see, we've been on these levels before, on this support line, resistance line before. We are here, 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 and here, as well as here and here. So this tells us that this is a strong support and resistance level. So if we see price move higher, I wouldn't trade it right away. I would wait. If we see price move up, I'll wait for the price to move down and hit the what it will be now a support line, and then when the buyers come back and push the price higher, if we break above these levels, the previous high, then it is a signal that the price will move even higher, and that is where I would buy. But overall, I would be cautious and wait and see price fall down to the support line, and if it does break this support line, then this area is a major plus. The further it goes, the stronger the buy. But if we break below this line, then that's to me a buying signal. So I'll be cautious here. I'll be waiting and see if the price moves up. I'll wait and wait and wait until it breaks above, and then I'll keep on waiting. If it breaks down and the buyers come back and push the price above the previous high, then I'll buy. Otherwise, I'll wait here and watch and see if I will buy here. And if we buy here, then we might see at least a 20% price move, which is great. It's not huge, but it's okay. But the dream would be to buy on this area. So that's how I would trade the stock. Now, how would you trade the stock? Please let me know in the comment box below. And that's it for this episode. Thank you so much for watching. Please give me a thumbs up, comment, subscribe, and let me know what you think, but also what stocks you want me to take a look at. Thank you so much once again for watching. Until next time, take care. Bye bye.